Welcome to HPT Intelligence Series, file number 06, Operation Exit Velocity. We'll be looking into the SPACEX file, examining the squeeze, story, and the July 6th, trap through three lenses, the tape, the story, and the structure. This video is not financial advice. Our executive thesis describes a real squeeze, a story stock, and a timed trap. The market's recent strength is underpinned by a float and lockup structure engineered so the stock almost can't go down, until it has to. We will examine this through three lenses, the tape, the story, and the structure. Our method is to start top-down, answering 6 key questions in order: index, sector, stock, macro, fundamental, and technical. Answering these tells you where you are in the food chain. It's a roadmap, not a hunch. 2 weeks ago, the tech sector rolled over before the IPO. Today, hot PPI prints sent the tape selling to the lows. An Iran deal headline hits, pausing the strike and causing a vertical bottom. Tomorrow, SPACEX prices, with hype meeting a SUB 5% float. By July 6th, index inclusion forces ETF buying before lockups bleed out. Today's reversal, by the numbers, shows NASDAQ 100 up 3.29% off the lows, and the VIX closed down 12.5%. The desk read, green across the board, but the vertical V off the lows on a headline is a squeeze, not accumulation. Index is still capped below the 22-day. We are not out of the woods. We will walk through 7 sections: the tape, relative strength, the story bull, the story bear, the structure, the wave, and the HPT playbook, showing where the three lenses agree, where they fight, and the deciding levels. Section I focuses on the tape, why we reversed, and how the desk traded the rip in real time. At 8:30 a.m., PPI printed hot, the open faded, and price ground straight into the lows. Shorts were pressing. This started with a hot PPI print, followed by a fade of the open, driving the price into the lows, which represented maximum pessimism. Between 12:30 and 1 p.m., a peace deal headline hit right as price reached one specific spot, the lows. This acted as a catalyst, driving the market up in a V reversal. The volume and leveraged ETF imbalances hinted at a powerful move. The anatomy of the move follows 4 steps: spike, confirm, retest, and ride the lightning. On any news move, always wait for the next bar. The confirm tells you the story. Yep, we know, and we're still buyers here. The divergence was key. Sitting right at the lows, price made a lower low while RSI made a higher low. This indicates that the selling was losing momentum. Paired with the headline and imbalance, it raised the odds of the push, although it doesn't call the bottom by itself. The single most useful tool on a headline day is anchoring the VWAP to the news event, not the open. From that anchor, the level becomes a clean map. Acceptance above the news VWAP means buyers are in control from the catalyst forward. If you miss the spike, the news VWAP offers a repeatable re-entry point. Wait for the test, confirm the hold, define your risk against the anchor, and then let it push. You still ride the move, just later in the food chain. Buy imbalances represent a forced bid hiding in plain sight. When ETF order flow piles up on one side, market orders don't fill cleanly, making the book imbalanced. Levered and sector ETFs must hold exact exposure, forcing them to buy what they are underallocated. Imbalances settle by 3:30 p.m. A 4.5% jump in 3 minutes near 3:30 p.m. is not conviction, it's machine rebalancing. Algos can't perfectly measure exposure in real time, leading to mechanical moves. Knowing the largest names in the product, like Micron in this case, tells you where the bid will land. This is real-time analysis of market events. Strikes were canceled, trapping shorts, with imbalances favoring the buy side. We prioritize getting out of broken shorts first. Heavy buy-side imbalances were noted, with SOX bouncing a key level and still being bought. The SanDisk trade generated significant returns, with next week calls trimmed by 3:30, resulting in a 150% gain. A second tranche was scaled for a 40% gain, with a hard stop defined on entry. The move was a mapped setup, not a chase trade, driven by sector strength, a clean pattern, strong order flow, and the 3:30 imbalance as a catalyst. Not all resistance is equal. Know who made the level. Resistance built by early retail panic is weak and easily cut through by momentum. Strong resistance is set by institutions at end-of-day closing levels or prior-day settlements, which are defended with size. Respect these levels, as they are where a real test occurs. Discipline means fixing what's broken first. Stop the bleeding, go flat to regain a clean slate, and then reassess the new tape without the anchor of a losing position. Finally, re-engage on plan with defined risk. Your next trade is only as good as the headspace you take it from. The tape provides a playbook, not a prophecy. The move was a headline squeeze, not a new bull trend, confirmed by anchoring VWAP to the news. Respect the 3:30 ETF settle, which creates mechanical bids. Remember, the market is still capped below the 22-day moving average, so we are not out of the woods yet. Section 2 focuses on relative strength, identifying where the money actually went and how to find the leaders before retail. The following scenes will detail this process, which starts with market indices and drills down to individual stocks. The cleanest tell for relative strength is the moving averages. If a sector is above its 12-day and 22-day moving averages while the index is not, that's your shopping list. The 12-day signals near-term momentum, while the 22-day is the trend gate for the intermediate tape. The spread shows the strength. The divergence was clear. Semis, SPACEX, cleared both the 12-day and 22-day, showing strength. In contrast, the index QQQ cleared the 12-day but remained below the 22-day. The relative strength was clearly in the semis sector. Drilling down to subsector detail, the equal-weight semis, ESOX, were even stronger than the cap-weighted, ASOX. This breadth detail confirms the move is broad, indicating strength across the group, not just a few megacaps carrying the tape. Running the funnel from index to sector to subsector to stock reveals the leaders. Names like ASML, KLAC, SanDisk, and Micron emerged as key breakouts, driven by the memory bid and supply chain dynamics. A roadmap beats a hunch. The initial move targeted the capital equipment makers. ASML and KLAC broke out first. This led to Lam Research, leveraged to memory. Finally, memory names like Micron and SanDisk followed. The WDC SanDisk stock swap cleverly avoided forced sellers in the float. The funnel also tells you what to ignore. Software, IGV, was below both the 12-day and 22-day, so you avoid chasing that group. Space, UFO, held the 55-day, a setup worth watching into the IPO and the broader SpaceX narrative. The repeatable process involves 6 steps. First, read the index. Second, identify the sector strength. Third, check the subsector for breadth confirmation. Fourth, select the cleanest stock breakout. Fifth, confirm with flow. Sixth, determine the food chain positioning. This systematic approach scales your edge. The handoff to Asia is the overnight question. The US close squeeze is only half the story. The real test is whether the move holds abroad. Asia is sitting above the 12 and 22-day, but holders may de-risk into the unknown. The way to answer the uncertainty is to watch how it actually trades after the IPO. The rest of the tape, specifically crude oil and the VIX, is not yet buying the all-clear narrative. Crude only gave back 4%, indicating oil isn't convinced the conflict is truly over. The VIX drop was relief, not resolution, closing at 19.44, low, but without the capitulation needed for a true bottom. The leadership map is the actual trade. It involves identifying relative strength using moving averages, recognizing that semis are currently driving the market, and confirming breadth. Also, note that the macro hasn't confirmed the quote clear yet, so stay hedged while leading with leaders. Section 3 focuses on the story, particularly the bull case, the vision, pricing power, and the trillion-dollar dream that the IPO is selling. This narrative provides the emotional and aspirational fuel for the stock's initial movement. The whole setup is driven by demand. We see $100 billion in retail demand. The IPO is 4 times oversubscribed, and major institutions like BlackRock, along with sovereign funds, want in. This desperation for shares, combined with deliberately tiny supply, sets the stage for a potential pop. The investment thesis is centered on the compounding vision beyond just Starlink. It includes Starlink as the cash engine, space data centers as a new catalyst, the long-term dream of manufacturing on the moon, and the labor layer provided by Optimus and AI. Starlink is the cash engine, and its strongest pillar is its pricing power. Airlines are eager for it, and the high-value deposits and multi-year waitlists show demand is outstripping supply. It holds a genuine, albeit temporary, moat in low-orbit broadband at scale. The current IPO timing is driven by the catalyst of compute, specifically data centers in space. The shift from the telecom era to the compute era means building deep space infrastructure is necessary to harness abundant, cheap tokens, a story worth $1 trillion if successful. The bull thesis's trump card is the 24/7 sun-free power in the Terminator zone for continuous solar energy. The promise is to print GPU tokens at a fraction of Earth cost. However, the bear case questions whether token value will fall faster than demand grows. The central claim is that, Hawaii satellites are easier to make than Starlink ones. If true, orbital compute scales fast, offering a structural cost advantage. However, caveats include rapid chip depreciation, cooling difficulties in a vacuum, and Google's projected 2035 viability. The moon vision ties the entire story together. Colonize, manufacture satellites from lunar resources, and use a railgun to launch them to orbit cheaply, all run by Optimus robots. This story sells the dream of coming from the moon, not just going to it. The sex appeal of the story is undeniable. featuring sci-fi concepts like lunar railguns and space robots. This narrative generates strong belief in FOMO, which, for traders, means monitoring the financial flows created by that belief, regardless of personal conviction in the vision. The venue choice for listing is crucial. SpaceX's choice of NASDAQ over the NYSE offers a leverage point. This competition between venues allows the company to negotiate the listing rules, potentially influencing the structure of the IPO itself. The bull case is strong because the supply is tiny, Starlink offers a real moat, and the vision compounds. Most importantly, white-hot belief moves flows. You trade the belief, not the discounted cash flow, for a story stock like this. The story is strong enough for an initial pop due to demand, the Starlink moat, compounding vision, and small float. However, the trade turns on two issues: the economics of space data center tokens, and the structural impact when 13 times the current shares unlock. Section IV shifts to the story, focusing on the bear case. This lens examines where the ambitious vision collides with physics, math, and the company's track record, highlighting the cracks worth pricing. The core problem is token math. The entire vision relies on mass-producing GPU tokens. While demand is growing, the cost of tokens is collapsing much faster. If price falls quicker than usage rises, the company is building a commodity, not a moat. Token usage growth has dropped significantly, from a 50x multiple to 6.7x in a single year. While still substantial, this deceleration indicates that the vision priced on infinite exponential demand needs to be reevaluated. The price per million tokens has collapsed from $20 to 40 cents, a roughly 50x drop for the same capability. The trend of increasing efficiency in chips, models, and usage is highly deflationary, meaning you are supplying something whose price is engineered to fall. When price falls faster than demand grows, a product commoditizes. Demand growth is slowing, while price collapses faster. This pushes the product toward becoming a utility, like a railroad, which doesn't support a high valuation multiple. The valuation of approximately 97x is priced for a moat, but is exposed to a commodity. This tension exists because the long-term hold requires pricing power growth, yet the token economics suggest the opposite. The narrative must consistently outperform the underlying data. The intuition that space is cold and cooling is free is incorrect. The lack of atmosphere means wild temperature swings, and no air makes heat transfer difficult. This, along with the need for noxious coolants and robots, makes cooling extremely challenging. Even optimistic estimates place the viability of space data centers around 2035. This long timeline, coupled with commoditization, creates opposite forces. The vision is possible, but the value driver is distant and faces a shrinking economic target. A conservative projection of 35,000 robotaxis was missed by almost 99.9%, with only 42 on the road. This internal forecast versus reality is the most comparable data point for assessing the execution schedule of the larger space vision. The orbital plan relies on robots like Optimus to perform complex tasks, but fundamental problems in dexterity and battery runtime remain unsolved. You cannot staff a space economy with early-stage, unproven robotics R&D. The orbital data center thesis hinges on centralized inference, but industry reality is moving toward running models on the device. Local inference eliminates the need for round-trip data center visits, potentially flattening centralized demand as supply expands. Starlink cut its average revenue per user from $99 to $66 to accelerate subscriber growth ahead of listing. The headline growth comes with price-cut fingerprints. The moat is real, but the true health of the business is revealed by reading the ARPU. Satellites have a short 5-year deorbit cycle. Placing fast-aging GPUs in orbit subjects the most expensive assets to a short clock. This constant replacement cycle crowds orbit, exacerbating the problem of space junk. The vision for space is fundable, but the near-term economics do not represent a moat. The token demand price scissor leads to commoditization, physics fights the plan, execution lags, and even Starlink has inherent asterisks. We now move to Section V, the structure. This section explores the float and lockup mechanism, explaining why the stock can't drop until it's designed to do so. The listing was fast-tracked by leveraging competition between exchanges. The exchange bent its rules to compress the typical seasoning period for index inclusion from 90 days to about 15 trading days, accelerating the supply schedule. ASUB 5% float, specifically approximately 4.2%, serves two purposes: meeting the relaxed inclusion threshold and guaranteeing scarcity. With minimal supply meeting $100 billion in demand, the open is mechanically pushed higher. This pop is intentional design. Index inclusion is set for 15 trading days, significantly compressed from the old cadence of approximately 90 days. The reduced time frame means hype has no time to fade before index funds are obligated to buy, ensuring a price pop. A generous 30% allocation to retail is suspiciously locked for 15 days, precisely aligning with the inclusion date. This means retail and early holders can sell the exact moment index funds are forced to buy. Supply meets a guaranteed bid. The mechanical open involves an allocation near $135, followed by a flood of market orders against almost no float, causing a price gap. This structure ensures that everyone who received an allocation is instantly profitable. The pop is the product. 3 key events are engineered onto the same date. The IPO pop leads to the 15-day lockup end, which collides with index inclusion and forced index buying. This collision creates the handoff, where smart money distributes to passive buyers. The public float is currently around 4.2% of shares, but this increases roughly 13 times, to approximately 53% in a year. The initial scarcity that drives the opening price reverses as supply unlocks in waves. Demand must grow 13 times, just to hold the price flat. The typical structure path shows a vertical pop into inclusion, followed by a grind into the index bid, then lockups release, and a 30 to 50% bleed off the top over the following year. This illustrates the sequence of the squeeze and subsequent flood. The structure is designed so that sellers, allocation holders, early investors, and the company itself can distribute shares precisely when passive index funds are forced to buy. The smart trade is to be early to the pop and out before the supply flood. The initial scarcity makes the stock mechanically unable to fall for about 2 weeks, setting up Act 1, the squeeze up. Act 2, the flood, begins when lockups release and supply grows, leading to a 30 to 50% bleed. The pop is engineered through manufactured scarcity, and the calendar dictates the collision of the 15-day lockup and inclusion. With supply increasing 13x, trade the act, not the dream. Be early to the squeeze and gone before the flood. We are now in Section 6, the wave. This section focuses on timing the lower high using the wave count, the VIX signal, and the July 6th lockup collision. The recent bounce followed a genuine drawdown, with the Nasdaq shedding 8.34%. This created enough fear for a reflex bounce, raising the question of whether this is the bottom or just a bounce within a larger move down. The current market movement has the shape of a Wave 2 bounce, indicating a relief rally that forms a lower high, not a new trend. If the count holds, a Wave 3 leg lower is the higher probability path next. The powerful relief rally across major indices, including plus 3.29% for the Nasdaq 100, is typical of a violent Wave 2 bounce designed to trap buyers. Treat it as a lower high until the prior peak is reclaimed. The VIX, which called the market bounce, now signals an 85% chance of a down day across the next 2 sessions. This relief, followed by resumption, is consistent with the Wave 2 interpretation and points toward a lower high. July 6th is the critical date, as forced index buying meets a holiday-thin tape. With markets closed for the July 4th holiday, the index funds are required to buy when SPACEX is added to the Nasdaq 100, providing a guaranteed demand wave. The path maps out 2 distinct sell-offs, around 1 forced buying top. The first sell-off already happened, funding the offering. The second sell-off, a post-launch drift, is expected into early July. The subtle but critical mechanic is that index funds cannot buy on IPO day. The massive passive bid is delayed until inclusion is official, around July 6th. Creating a time-delayed, forced demand spike. Crude oil is a major wildcard, coiling near triangle support. If global conflict fears ease, oil would break down hard. A renewed oil shock is the macro risk the current equity bounce is not pricing in. The current setup rhymes with the euphoric top of the dot-com era in 2000. That period saw a blow-off top on narrative, not earnings, resulting in a nearly 40% Nasdaq drop in about 10 weeks off the high. In summary, we see a strong bounce in a weak macro context, leading to a scheduled top around July 6th. The VIX leaning down also suggests a high probability of a down day soon, and oil is the key wildcard to monitor. We are moving into Section 7, the HPT playbook, which details how to integrate the 3 lenses, the tape, the story, and the structure, into a clear trading plan. All 3 lenses agree. The first move is up, the current bounce is suspect, July 6th is the pivot, and supply ultimately wins later. This consensus across data points provides a strong directional roadmap. The tension points are key to finding the edge. The structure resolves timing conflicts, and the narrative versus bear math highlights the temporal difference in the trade. The unified read is to trade the squeeze and respect the trap. The long bias is tactical until early July, after which the short bias is favored due to the forced buying top and subsequent supply flood. Our base case, with roughly 55% odds, is a pop into July 6th, followed by a 30 to 50% bleed as supply unlocks. The bull and bear cases depend on reclaiming prior highs or an early oil shock, respectively. The trading plan has 3 phases. Phase 1 is the squeeze long into early July. Phase 2 is flattening and arming short triggers into the July 6th top. Phase 3 is fading rallies post-inclusion. Key levels to watch include the SOX 12 and 22-day moving averages, ASOX 2592, the QQQ 22-day, UFO 55, crude 87.90 seconds, and the VIX close of 19.44. Print these levels for quick reference. Critical risk rules include defining your risk first, fixing what is broken, sizing appropriately to the phase, respecting the July 6th calendar, and trimming gains into vertical spikes. Here is the one-page cheat sheet for Operation Exit Velocity, summarizing the tape, the story, the structure, the plan, the levels, and the risk. Use this as your roadmap. Remember, trade the squeeze, respect the trap. The three lenses offer a clear roadmap. Thank you for watching this video from Hollow Point Trading. The links for more analysis are on the screen.